Dutch Bros has been increasing its beverage drive-thru locations significantly. At the end of 2019, there were a total of 370 shops. By the end of March 2023, this number had increased to 716, with 278 franchised shops and 438 that are company operated. And management has ambitious plans for growth. It wants 1,000 shops by 2025 and 4,000 shops in 10 to 15 years' time. Looking at the latest financials, the company has a market cap of $5.3 billion with $14 million of cash and $96 million of long-term debt. Revenue over the last 12 months is $784 million. Adjusted ebitda is $47 million, but the company recorded negative net income and negative free cash flow. So the company is valued at 6.6 times revenue or 113 times ebitda, with gross margins around 25%. As a beverage drive-thru operator, Dutch Bros revenue is divided into three segments. Coffee makes up 50%, energy drinks, including their own Blue Rebel brand, makes up 25%, and the other 25% is from teas, sodas, and smoothies. The challenge with this impressive growth is continuing to find profitable locations, and Dutch Bros margins cause some concern. Their operating margin in 2019 was close to 13%, but it's fallen to zero over the last 12 months. This was mainly due to an increase in rent and in the prices of raw materials, particularly coffee beans. So a key consideration for investors is whether the decrease in margins is a warning signal for things to come. On one hand, the drop in margins may be part of the company's strategy. Affordable prices and memberships are a good way to develop customer loyalty and drive growth, which can be monetized down the road. On the other hand, if Dutch Bros is unable to pass costs to the final customer, it means the company's profits are too dependent on raw materials and management can do very little to impact margins. Based on financial statements, Dutch Bros earns a little over $1 million for each one of its stores. So let's say the company manages to hit 3,500 stores by 2033. In that scenario, annual revenue might be in the region of $4 billion. The company is targeting 30% EBITDA margins, but after stock-based compensation and other expenses, the net margin is likely to be closer to 15 to 20%. Assume net income then of $700 million in 10 years' time, and a multiple of 25 times earnings takes the company to a valuation of $17.5 billion, which works out to an investment return of 12.9% per year. That's not a great return for such an aggressive and optimistic forecast. Ultimately, this seems like a lot of risk to take in a crowded, competitive market. That said, I've never been inside a Dutch Bros, so I can't comment on the quality of the product. For now, I give the stock a neutral rating, but these are my personal opinions, not financial advice, and I've got no position in the stock. For more detailed investing ideas, visit our website, overlookedalpha.com.